Hey guys, how you doing? This is Israel, and you know that this is the Israel Keys Wealth Academy because you are enrolled in the Israel Keys Wealth Academy. Right. So this is another mentorship session. Usually we hold these over the weekend, but I was just going through the markets today, and I thought, based on some of the stuff that I was already beginning to put out on the Experience WhatsApp forum, I needed to break a couple of things down just so it makes sense. And as you know, we are doing things from both ends of the floor. So with the Market Breakers course, we're starting from the very basics and building up. So we're dealing with the nitty gritty. If you're an experienced trader, you might think you don't need this stuff. Trust me, you do, because I'm very sure that at least every person will at least find one area in which you realize that you might not have had the best form of foundational grounding. So please go through the beginner stuff, listen to them, look at the manuals, take notes, especially the bits that talk about the psychology and how to understand what's going on in the markets by what you see on the chart. That in each session, in each section, there's a focus on this is what this trading concept means when you see it on a chart. Please take the time to build that mindset of what drives the markets. But for those of you who are more experienced, the mentorship sessions are the ones that will really take you deep from the start, because we're going in at the deep end already and starting to deal with practical concepts that you can apply and you can use in the marketplace. So with that being said, let's deal with something that I really wanted to show you guys. Now, one of the reasons, in my opinion, why many traders don't do well in the markets is they don't understand what we call market. Now, we dealt with market phases last time. Now, I want to deal with what I call market conditions. In essence, when you look at a chart at a currency pair or the currency basket of pairs as a whole, before you jump into a trade, there's a couple of things you should ask yourself. And one of them is, what condition is the market currently in? And this is subjective because whatever time frame you are on will determine that. So let me give you an example of what I mean. Now, first of all, there are three time frame or three market conditions you should understand in a generic term. Let me take the dividers off so the chart becomes a bit cleaner. The first is what we call the consolidation phase. Like we spoke about this when we talked about market profiles and phases. So consolidation is also a market condition, and it simply means when price is being held in a clearly defined range. And the size of that range in terms of pips will have a lot would depend a lot on what time frame you're looking at it on. So for instance, on a weekly chart, this is a consolidation. You can see this here in November. Let me do one that's a bit closer so that we go back and look at it. So this is a consolidation here. Right now, this pair we're looking at, which is the US CAD, it's called the loonie, partially because in trading, it acts crazy. But I found out recently that the loonie is actually a concept that is particular to Canada. So they have, I'm not sure exactly what it is, but there's something called the loonie that is a part of Canadian culture or whatever. But we just thought in trading for years that it meant the currency pair moved mad, literally, because it literally does move mad when you don't understand price action concepts. When you get to understand price action concepts, you realize that the beast can be tamed. It's just because it moves very, very quickly between the different concepts. And so retail traders with their fancy trend lines and stochastics and everything don't understand what's going on half the time with this pair. But if you look at it through the lens of the stuff we teach, it makes perfect sense. So this is a consolidation. Price is held within a clearly defined range. Now, on a weekly chart, that range is 427 pips. That sounds crazy. But for weekly chart, it's a consolidation. So if you're trading and keying off the weekly chart for your levels, that's a consolidation. If you drop down to a daily, this becomes a trend. And even more so of a trend when you drop down to a 4 hour. So if you saw this on your chart, when you opened your 4 hour chart, and somebody told you this was a consolidation, you would say they were crazy, because it's not. Look, it's trending up, it's trending down, it's trending up again. But on a weekly chart, it's a consolidation. So let's make this clear. When we talk about these market conditions, time frame has a lot to say. Let's go back to the 4 hour chart. So now in the 4 hour chart, this is another consolidation here on a 4 hour level. This here is a consolidation. Why? Price is held in a clearly defined range. Now for a 4 hour chart, that is 74 pips, a lot lower as you would expect, because it's a lower time frame. And something you need to understand when you look at charts, especially a MetaTrader, is they're not always drawn to scale. Bear that in mind. You could put two currency pairs side by side, and the same level of move could be twice the number of pips on one as the other. They're drawn relative to what's already come before. So please be in the business of taking this crosshair tool here and checking the size in pips of a move or a pattern or whatever. Don't just look and guess, because what looked like what was 5 pips yesterday, the same size of candle tomorrow could be 15 pips. So always check that. That's very important. Now let's drop down to a 15-minute chart and look at that little piece of action. Let's see, that was, so it was roughly the 28th, 25th to the 28th of November last year. So we drop down to a 5-minute chart and we go find November last year, 15 minutes, sorry. And we go find November last year. You'll see that what was a, there we go. What was a consolidation of 4-minute chart could be seen, quote unquote, as several trends here. And again, we're going to do this one more time. This is a 15-minute consolidation right here. Again, price is held in a clearly defined range here. And what's the range on a 15-minute chart? It is 22 pips. Again, smaller time frame. So that's clearly a consolidation. If you, this is the 22nd of November, if you drop down to a 5-minute chart on the 25th of November and you go back and look at it, you'll see, or maybe we should go to a 1-minute chart actually, but let's see, because 15 to 5 is very close. But you'll see that what is a consolidation on one, there we go. There we go. So still looks a little bit like a consolidation, but you can see it has a lot more movement in it. And if we go to a 1-minute chart, this should be fun, trying to find a period of time on a 1-minute chart. It should take forever to scroll back because you're scrolling back in blocks of 1 minute. I don't even know if the chart will have the data all the way back there, but let's see. Let's see, we're trying to get to November. We're still in January. Just be patient. This is gonna take a while, but it's worth it in my opinion to show you, because it's all well and good explaining it abstractly, but I want you to see it with your very eyes. So we're looking for the 28th roughly of November. Okay, well, so this is as far back as it'll go on a 1-minute chart, yeah, because there's a defined number of candles you can go back. Okay, that's fine, but you get the point anyway. So let's go back to the weekly. So that's a consolidation. Why is it important? Because when price is in a consolidation condition, there's some rules you follow. The first rule is you cannot trade at that moment on the time frame it's consolidating. So if you see price consolidating on a particular time frame and you need to trade, which you shouldn't, as we've taught you, but if you believe there's a valid trade, the rule is drop down at least 2 time frames to pick an entry. You could get away with one, so at least one time frame, sorry, and preferably 2. So if it's consolidating on the weekly, you want to be taking your trade on the 4-hour at least. If you see something sensible on the, for instance, if you saw this bullish engulfing here on a daily, that's 44 pips. If you traded it down to the bottom of the frame somewhere around here, so you could get sometimes you get a very valid trade on the time frame beneath. Preferably though, if you got in here, say for instance you got in here on the 4-hour, you can see how that would have been a very 37 pips to almost 300, over 300 pips. That would have been a very profitable trade. So first rule is don't attempt to enter a trade on that time frame. Second rule is assume that price will stay in that consolidated range. Don't assume a breakout. In essence, if you take a trade at the middle or one end, until it breaks out, don't guess when it will break out. And so if it's moving in one direction, follow it to near the end of the range and then get out and wait for it to confirm a breakout. Thirdly, even in your anticipation of a breakout and therefore the direction in which you are going to be taking your intra-consolidation trades, refer to previous price action within the context of what we taught last time: the contraction, manipulation, expansion, retracement, and follow through to target profile. And ask yourself, where does this consolidation fit in the larger picture? Where does it fit in the larger picture? So is it a consolidation before a manipulation and then an expansion? Has there already been a manipulation and an expansion? Try and frame it within, but in essence, don't be trading on that time frame. If you want to trade, in essence, you can, if you are a 4-hour trader and you see a weekly consolidation, that actually gives you a framework to frame your 4-hour trade. And so if I'm a 4-hour trader and I see what we call a market structure break here, we're going to do a mentorship session on that on its own. I think I'll get Tucker to do that. So this would be a market structure break right here. Let me get rid of these colors now. Just go back to 4-hour. So this right here, delete. And because it's a 4-hour, my cadence is purple. You guys know this by now, except you're new. I have a different color for everything I do on a time frame that lets me know what time frame it came from when I want to know. So there's a market structure break. Perhaps this will be the best one to use actually here. So price takes out that low, comes back, and then confirms the market structure break by going low again here. So at this point here, I now have a short bias on a 4-hour chart. If I let's put a divider line there to let us know what day we're on. So that's the line. If I confirm with my daily, because remember I said we only trade in the direction of daily engulfings. There's been a daily engulfing this way. Well, so there was another one the other way. So perhaps I would wait till it got here. And at this point, this would be the point at which I would now be cleared for entry. I know it sounds annoying. Well, if I got in here, for instance, I can ride it through. But if you are entering the market at this point, you want to wait for the next daily engulfing. So let's go back to the 4-hour chart. So at this point here, these are all now valid trades. In essence, whenever price, anytime price came above this level, I'm shorting, right? You get in, boom. So you can get in the first time here. It comes back to give you a second opportunity, and then it goes. Since I know that this is a wider consolidation here on the weekly. So let's see. At that point, before that, because remember at that time, this Let me show you what I mean. At that time, this was all that had formed. At the time of the entry, this low hadn't formed here. So at that time, the consolidation would have been this level there. That was the established low at that time. And so I can draw a level there and then take that away. Send it to weekly chart. We're going to put that in red. That's my weekly color, not orange, red, red, red for danger. Right. So we go back to the 4 hour. And therefore, I now have a clearly defined range for my trade. So if I get in here, put my stop loss there, that's 40 pips, which is not a lot on a 4 hour chart if you're trading the 4 hour chart on its own without refining downwards. And that gives me roughly 160 pips worth of trade. That's 421. So that's valid. And at that point, I realized that once we get here at this line, I could either just get out immediately there. If it goes down, comes back up there. This is, in essence, at this point, anywhere in this area, price is telling me, get out, right? So this is the trade range based on understanding the fact that I was in a consolidation market condition on the 4 hour, on the weekly. It then gives me wisdom I can apply to lower time frames. So you see how, like I said, you don't just jump in and start applying the concepts we're teaching willy-nilly. You ask yourself, what market condition am I dealing with on my reference time frame? In this case, it's the weekly. So you apply it. And you see how this would have been a spectacular trade. Market structure break up here. Wait for confirming D1 engulfing. That's the level there. You get in. You make 421. You get out. And then on its way back up, you could do the exact opposite. So on its way back up, this would have been the first market structure break here. Right? That would have been the first market. Let's put that in purple. That would have been the first market structure break. And so at that point, when it starts to go up, you're looking bullish. Again, we are waiting for, so let's put this there from where the break happens. We're looking for a bullish engulfing. There we get it. We actually get the bullish engulfing on the same day the 4 hour market structure break happens. So we're good. So anything from pretty much this point here, we are happy to go long. And so we could literally go long straight off the moment it crosses the market structure break, or we wait for it to come back down because we know it's likely to. This is one of those areas where you would then perhaps find the middle point of the liquidity profile, which in this case is an order block. So we're looking for 50%. Delete that. This is a 4 hour level, so purple. And what do you know? Look at price touches it perfectly. This is, see, when you understand this stuff, it is just beautiful. Look at that. Almost to the pip. And so you would be in there. In essence, that would be the beginning of your trade. Put that back in black because it's not coming from a particular time frame. It's just an arrow. That would be the beginning of your trade. This would be your stop loss. And to get a, let's see now, to get a 29 pips stop loss on a 4-hour trade is more than you could ask for in your wildest dreams. But where do you get out? You get back out at the high of the established consolidation, right? So at the time, this was the high of the established consolidation. Now, this is a trick here. You can look at that on a weekly chart. You see, that's a very wicky candle. It's very wicky for a weekly chart. The fact that price was driven back in that level tells us there's an order there that didn't want to take it, that refused it going further north. So in that scenario, I would be more inclined to use the body of that candle, or the highest body. So as opposed to the wick, the highest body of any of the candles in that, which would be that one there. Let me explain again. Technically speaking, let's put that in red first. Technically speaking, this would have been the high of the consolidation. But look, that candle's too wicky for my liking, right? And even if it wasn't, it's usually just wiser to use the bodies, because the wicks tell you that there are areas where price was driven back. And so this candle's body here is higher than this candle's body here. And so I would have made that, look, the high of my consolidation range. And of course, it looks like magic, doesn't it? Because when you drop back down to the 4-hour chart, you get in here, your stop loss is 29 pips. You can confidently ride it all the way to there. What's that? 300. That's more than 10 to 1, isn't it? Yeah, roughly 29 pips to 340 pips. See, just if this doesn't prove to you what we've been shouting, nothing will, right? And so when this is going up, all the time is coming down, you just ignore it because you've seen that you're already in a weekly consolidation. And until it breaks out of the consolidation on the weekly one way or the other, you're going to assume it's going to stay there. That's the beauty of trading with higher time frames. When price gets into one of these conditions, whether it's a consolidation, a trend, or reversal, especially a consolidation and a trend on a higher time frame, anything from daily above, it tends to stay there for a significant amount of time. And when do you realize that the move has given up the ghost? At that point, when it comes there? Well, two things. First of all, there is a, what you call it now, a 4-hour market structure break the other way. And again, you could pick which of the ones you chose to use here. Just from experience, I'm going to use this one because it's the most significant of the lows in this wiki period. This is technically a consolidation here because the move is dying out. And so that happens. And I didn't pick it because of this reaction here, because sometimes price doesn't come back to react. But of all these bunched lows, that's the lowest one. That's the most pronounced one. And what do you know? Price breaks through, it comes back and respects it's coming back down. At this point, the move has died. So if you didn't close in this area here, the moment price gets here, right, and refuses to break through that any longer, in essence, sometime around yesterday or today, if you hadn't, because technically I would have just gotten out here. That's the top of the consolidation. But in case you thought he was going to break through, the moment he comes back there, you just cut your losses and you close for profit. Now, that is still what? That's still pretty much 10 to 1. Can I interest you in 10 to 1? Over how many weeks? Let's see. That move would have taken 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, maybe 6. Still 10 to 1. And this is trading a weekly chart. Remember, this is trading a weekly chart now. So the weekly chart was our reference chart. So if you're a position trader, which is a weekly chart, and you're making 10 to 1 every month, you're a big boy. This 4 to 1 would have taken 1, 2, 3 weeks. 4 to 1 a month. If you just made 4 to 1 every month, you'd be fine. Of course, we're starting with a weekly chart. You can do this on a 4-hour chart and refine it further down. And then the second thing we're looking for here would have been that there's a daily engulfing. And what do you know? The daily engulfing would have happened here, as you can see here. So you wouldn't even have waited for the market structure break. The moment you see the daily engulfing, you're out. And so the daily engulfing happened on this day. So that would have been roughly here. And therefore, you would have been getting out at this point here, which would have still been 11 to 1, I don't know, something like that, 12 to 1, something in that ballpark. So this is how, so I'm going to stop here for this one. I'm going to do another one with trending and another one with reversals. But you just have to ask yourself, on my reference time frame, what is the market condition? Is it trending? Is it reversing, or is it consolidating? I started with consolidations because, like I taught you in the CMERT profile, consolidations are the beginning of long-term market moves. So this is Israel. Hope you guys apply this and it makes you far better traders than you were before. Take care. Bye-bye.